Hi, this is Professor Nugent, and today I'm going to talk about Chapter 12, which deals with risk in relationship to capital budgeting. There's a couple learning goals that we want to discuss as we're moving through this. One big influence in this chapter is, of course, risk and how to measure risk appropriately to analyze capital budgets. Now, looking at different projects have different cash inflows and cash outflows, so we can use scenario analysis and simulations to help us to deal with, quantify, and understand risk. We are going to review the unique risks that multinational companies face. We're going to talk about RADRs, which are risk-adjusted portfolio discounts, which we use to help make projects more comparable when they have different risks. And we're also going to be using annualized net present values, ANPVs, which help to equalize and make projects comparable that have different time frames for their cash flows. We're going to look at the role of real options in selecting projects for capital budgeting and capital rationing. Okay, so let's start out with risk in the capital budgeting. So when we talked about chapters 10 and chapters 11 in this textbook, we're just introducing the capital budgeting techniques and capital budgeting cash flows, just the routine basic dimensions of those concepts. In this chapter, we introduce risk. So we want to get a little bit closer to the real world, and we have to assume that all investments and all projects have different levels of risk. And risk is a very difficult thing to quantify. But the more I can quantify the risks, the better able I will be to choose projects that meet my company's goals and needs. So, we can't assume that all projects are equally risky, which we were doing in chapters 10 and 11. So the acceptance of any project, will change as the risks associated with the project change. Now, it's very common for managers to use their experience overall to understand and accept what the risks are of a project. And taking on exceptionally risky projects can affect a lot of different areas of the company besides that one project. For example, the overall creditworthiness of the company can be affected and then overall raise the cost of borrowing for all future projects. So that's why risk is a key consideration in assembling your projects that go into your capital budget. Now you'll remember from chapters 10 and 11, we had this Project A and Project B, which had this series of 5 cash flows. So Project A had an equal series of 5 $14,000 cash flows for a total of 70,000. 1, 2, 3, 4, 5. Yes. And then Project B had an unequal flow of cash flows, 28,000, 12, 10, 10, and 10, also 70,000. So this is something that we looked at in calculating net present value for these two projects in the previous chapter. And we know that in Project A, the net present value is 11,000. In Project B, the net present value is 10,900. And making Project A, based on net present value, the projects we should accept. And it should be noted that both these projects have different initial investments. Now, what if these projects are of different risk? So of these two projects, if Project A happened to be much riskier than Project B, then if we're only talking about, $150,000 or whatever between, or $150 between the two projects, then probably should go with the less riskier project. So it's not always about who makes the maximum money, but we want to look at taking into consideration risk. So if Project B is risk-free over Project A, it's a huge amount of risk of that not happening, we should go with Project B. And that's the consideration we're trying to put in here. So a behavioral approach in dealing with risk and cash inflows. So the risk of a project is that the cash inflows that you're expecting won't develop. So we can use these behavioral approaches to get a feel for the level of the project's risk. So other approaches can quantify and measure the project's risk in a way that we can monetize. So let's talk about risk in the capital budgeting. It refers to the uncertainty around the cash flows. So cash flows is what we're at risk of not receiving the cash flows that we're projecting. So there is going to be a degree of variability in any project where we've outlined the future cash flow. So it's only a projection. So as the project gets out further in the future, things become even less predictable and risks increase even more. So length of time of the project is also going to be related to the risk. Now, we remember this formula should look familiar below. So this is the net present value formula that we've used in previous chapters. So let's look at this example here. So the Treadwell Tire Company, the tire retailer with a 10% cost of capital, is considering investing in project and 2 mutually exclusive projects. Remember, mutually exclusive means we're going to pick one or the other, but we can't pick both. So each require a $10,000 initial investment, and both are expected to provide a constant annual cash flows over the next 15 years of their life. So the project says equal lives, which helps make our comparisons a little bit easier. So for either project, of course, it would be acceptable when the net present value is greater than 0. So using Excel, we can calculate a break-even point. So a break-even in cash flow. So this would tell us at what amount of cash flow per year would we break even on the initial investment. So if we have a cost of capital of 10%, 15 years of cash flows, initial investment of 10,000, which we show as a negative because it's present value, that would, if we use the payment formula, that would calculate a break-even cash flow of 13, 14, and 74 cents. So if a cash flow is greater than $1,314, this is a approvable project. If the cash flow the project generates is less than the break-even, then we'll be losing money on the project. So this is another way of looking at whether a project's acceptable or not, is to develop the break-even cash flow amount. And we could use the Excel function formula payment to calculate. And that's something that we'll be doing in the Excel project for this chapter. Now, so if we look at, for the projects that we were just talking about, they must have an annual cash flow of at least, rounded up, of $1,315. So the risk can be assessed by determining the probability of the project's cash flows. Will equal or exceed the break-even point. So assume that a statistical analysis results in the following. The probability of the cash flow for project A is greater than 1315 is 100%, and the probability of cash flow B being greater than $1,315 is only 65%. So here we see that project A, both projects have a positive net present value, but there's only a 65% chance that project B will have that positive net present value, where project A is 100%. So it makes your choice simple. We would just pick project A because it's there's a lower risk. So now, if we talk about scenario analysis, this is again a behavioral approach where we're going to use several possible different outcomes, which we'll call scenarios, to obtain a sense of the variability of returns measured by the net present value. So in the capital budgeting process, the most common scenario approach is to estimate a net present value is usually a three-tier approach where we have pessimistic, most likely, and optimistic. So which you can also think of as worst, expected, and best scenarios. So that you can have many more categories, but this is just the baseline would be these 3 categories. So the range can be determined by subtracting the pessimistic outcome from the optimistic outcome, making it a range of the net present value. So here we could see that for project A, here are our 3 cash flows. Pessimistic, most likely, optimistic, and the range is 1,000 or 2,500 minus 1,500. On project B, which is riskier, we have a pessimistic of 0, 2,000, and 4,000, and the range being 4,000, which is 4,000 minus 0. So the bigger the range, the higher the variability or risk. Now, if we calculate the net present values, we'll see that we get 1,400, 52, and 9,000, a range of 7,000 in net present values. And here we have a negative 10,000, 5,000, and 20,000, which is a $30,000 range. Again, this is why one of the outcomes is potentially a loss, so that's why this project B has a lower percentage of outcomes with a net present value higher than 13, 15. Now, a simulation is similar. Simulation is sort of taking scenario analysis and running it through a model. So it's more statistical based behavioral approach where we're going to predetermine probability distributions with a set of random numbers related to the riskier outcomes to estimate risk. So by trying various cash flow components together with a mathematical model, we could run through a huge number of scenarios in a simulation to get a sort of a detailed output of all the possibilities within the realm of this project. So a simulation can be as simple as this model right here, where generate random number, probability, cash flow, and then net present value. And this model just kind of repeats itself over and over and over, where we're just generating random numbers. We can make a tolerance or set up a range of numbers that we want to put in the scenario from the least likely to most likely, and then run them through to get an overall idea of all the possible outcomes. Then we could graph them in the chart to see where they lie on some sort of scale graph. So now a Monte Carlo method is based on the scenario and simulation models, and this is something that is very popular today and was made possible from the large amount of computer processing power we have today. So the Monte Carlo simulation is a program that the goal is to randomly generate huge amounts of uncertain variables to over and over and over to simulate the model. Think of like a hurricane model or simulation where they have all these projected paths of the hurricane. That's what the Monte Carlo does. It keeps running numbers through and seeing what's the most likely path for the capital budget. So the simulation will require the people giving the inputs to develop low, high, estimations to correlate with the coefficients inside of the program, and it's just a very fast simulation that's going to run through a huge amount of ranges of variables to determine the correlation and coefficients of some of the most likely outcomes. And what's interesting, you could build this model in an Excel spreadsheet at first, and then when you have a model down with the variable inputs that you want to project for the project, you can run it on a more sophisticated program. But that's just the evolution. First, the idea of different scenarios developed, then more of a simple simulation, and then the highly computerized version of the simulation would be the Monte Carlo. All right, so let's talk about international risk considerations. So if you're looking to put together a capital budget with projects from across the world, you're going to have to deal with exchange rate risk. That is something that's unpredictable. It's very difficult to know the direction of the foreign currency. But there is, standard deviations of the range of the currency to say that the currency, there's a 68 or a 95% chance the currency will not deviate more than this variance. And that would be one of the inputs in a simulation. So short term, these foreign exchange risks can be hedged using foreign currency futures and option contracts. And long term, foreign exchange risk can be minimized by financing projects in the part of the world that they're actually going to be generating revenues and incomes from, so that the currencies spent can be offset with the currencies generated. Now, a survey of chief financial officers found that more than 40% of CFOs felt that it was important to adjust for our projects, for investing in projects cash flow or discount rates to account for the foreign exchange risk. So a lot of CFOs, more than 40%, so a majority of them, would want to adjust the project's cash flows uh, using discount rates to account for the foreign exchange risk. So kind of build that into the project. Now, other considerations are political risk. There could be change of government, change of leadership, change of uh, party dispositions and rules, laws, and how they view foreign companies and access foreign companies have to um, their domestic populations and markets. So political risk can be measured. Some countries we know of have very low political risk, like Denmark, and some countries can have a very high political risk, like Qatar. All right. So the difficulties of managing political risk is that a lot of things can be unpredictable, but it can be quantified to a small respect of we know which countries are riskier, which countries are less risky. So we can adjust the project's expected cash flows by the amount of political risk or interference that would be added cost of doing business in those countries. Other considerations are taxes. Taxes are different in different countries. Transfer pricing, moving products between countries. Um, Another strategic financial considerations that you may want to start a project in a country where you're not going to have a huge return just to develop a relationship with that country, and that would be a strategic move rather than a financial move um, for some manufacturers, some companies. Just get the foot in the door, even if you're taking a loss on it, and hopefully making more money later on. This brings us to the risk-adjusted discount rates, or the RADR. So one way that we can modify the net present value is to increase or decrease the discount rate based on the risks associated with the project. So we start with the company's discount rate, which is often thought of as the weighted cost of capital, or the average weighted cost of capital, and we may want to add a factor to this. Say, maybe the weighted average cost of capital is 7%, but we're adding 2% of risk to the discount rate, and that would be our risk-adjusted discount rate. And that will help us to lower the cash flows in response to the higher risks. So that would be this modified formula here, a formula we're very familiar with from chapter 10 and 11. Okay, so let's just think some personal finance example here. So this person is considering investing $1,000 in either two stocks, stock A or stock B. And she plans to hold the stock for exactly 5 years and expects both stocks to pay $80 in annual end-of-the-year cash dividends. At the end of the 5 years, she estimates that stock A can be sold for a net value of $1,200 and stock B can be sold for a net value of $1,500. Her research indicates that she would earn an annual return on the the average risk of the stock of 11%. Because stock B is considerably riskier, she's going to require 14% return from it. So she's going to make the following calculations to make a risk-adjusted present values for the two stocks. So here she's taking the $80 dividends and dividing by 1 plus 11%, or the risk for the discount rate with risk for project A, and then of course the remaining $1,200 when she sells the stock minus the initial investment gives us $7.81 net present value. On stock B, which is riskier, she's dividing each of the cash flows by 1 plus the 14% to the power, and then the $1,500 outlay at the end when she sells the stock minus the $1,000 gives you a $53 net present value, saying that stock A is not the best choice. Stock B would be a better choice, even though it's riskier, because the outcome is you're selling it, it's going to be appreciating more at the end of the 5 years. How they know, what's really a flaw in this example is there's no way of really knowing what the stock price is going to be in 5 years, that they could easily be, flip-flopped or greatly different numbers. So it's sort of a flawed example, but you get the idea that even if the risks are higher, if the overall, gain on the stock price at the end, it may make one investment that seems riskier actually a better investment. Okay. So when we're talking about discount rates, we know that discount rates are generally for most corporations are going to be the cost of their capital. And the capital asset pricing model helps us to define risk. And we know that risk is made up of non-diversifiable and diversifiable risk. So these two risks together, and it's just like the word says. Non-diversifiable risk means you can't buy other companies or other projects to mitigate the risks. A diversifiable risk, you can reduce this risk by diversifying your assets. So we know that assets traded in an efficient market, assets traded within an efficient market, the diversifiable risk, which is, the result from uncontrollable or random effects, can be eliminated through diversification. And the relevant risk, therefore, is only the non-diversifiable risk is the relevant risk, because we assume that everybody's able to diversify. Now, for owners of these assets, they want to make sure, you always want to minimize risk. So non-diversifiable risk for securities is commonly measured, easily measured by beta, which is the degree of which an asset moves in correlation to the market, which again we learned in previous chapters. So here's the capital asset pricing model again, as presented in multiple chapters prior to chapter 12, that we could help use to measure risk. Now, we can use this capital asset pricing model to help us to find the RADRs. So let's look at we're going to look at project L and R, and we're going to plot them. Okay, so we're going to look at project L and project R, and we want to look at internal rate of return for L and R, and a couple of things to consider. Project L generates a return greater than the required rate of return, and project L will have a positive net present value when its cash flows are discounted at the required return. If we look at project R will have a negative net present value when its cash inflows are discounted at the required rate of return. So R should be rejected. So if we look at this scale here, we have project R and project L. So you see that project R falls below the security market line. So this is sort of where we want the projects to be above this line. So the market is basically this line here. So we have the market return meets the beta of the market. So as the beta increases, the return needs to increase. So for the beta for L, we're actually going to plot the return is going to be higher than the SML. So anything below the SML line is reject, which have a net present value less than 0. Anything above the SML line is an accept, or net present value above 0. So this is just a graphical representation of capital asset pricing model and the security markets risk. And we can look at, here we have the risk-free rate, and we have the internal rate of return for project R. The risk of project R, so you see the risk of project R is greater than the return, so obviously reject. Here we have the risk for project L is less than the return for L, so that's why it's an accept. And of course in the middle we have the market return, which equals a beta of 1. Okay. Now, when we talk about capital projects, we have to also think in ethical terms, not just profit-only terms. So we have a company like British Petroleum, which went around for a good number of years shooting their mouth off about how great they are, how ethical they are, how they're investing in alternative energies, and they're a green company, and they repainted all their gas stations green and white with the energy symbol to really change their image. But behind the scenes, they're making capital budgeting decisions to buy risky capital budget decisions in some of their investments. For example, they could have bought more expensive, safer equipment for the Deepwater Horizon drilling operation, which they didn't. So they didn't have the most sophisticated, they had the bare minimum on some of their specifications on that offshore drilling rig. And we all know what happened. It eventually exploded. It sank to the bottom of the Gulf of Mexico, killing 11 people, including millions of gallons of ocean water. Um, so their stock price took a huge hit based on this crisis. So if the ultimate goal of the firm is to maximize wealth, then if you do it in the short run, it may actually be positive for the short run, but it affects your overall long-term maximizing your shareholders' wealth if your unethical decisions or come back to make the company look bad. So this is something to consider when you're making decisions at the corporate level. That you could do something that is right now going to save money, but long-term could be a problem. Sort of like think about the ethics of Flint, Michigan. The municipalities decided to save money by taking the drinking water out of a river that was highly polluted and highly toxified from so many companies dumping waste in it for so many years, rather than a much cleaner water source from one of the Great Lakes. And you could see how that decision, it saved money. However, it's sickened a lot of children with lead poisoning, and a lot of families were sickened by the toxicity of the water, which led to the firing and indictment and arrest for many municipal officials. So who really saved on that? The people of the town, Flint, Michigan, are now going to have to spend the state government and the federal government have to spend far more money to clean up the situation than if they had just left the water source, the more cleaner water source, intact. So ethics do matter. It's not just about saving money and improving profits. Okay, so let's talk about RADRs, risk discount rates, the risk-adjusted discount rates, and applying the RADRs. So we understand how to how to get a better handle on risk and measuring for some uncertainties. Now, when we're looking at project A and B, in addition to the data presented earlier, that we talked about this when we first opened up, the management has assigned a risk index of 1.6 for project A and 1.0 for project B, which I'm going to show you in the following table. So the required rates of return associated with these indexes are then applied to the discount rates to do project determine the net present value. So what we have here is a scale where we have a risk index from 0 to 2. So project A lies here, and if a project has a risk index of 1.6, then the RADR is going to have to be 14%. Project B, which is less risky, at a risk index of 1, will have a required rate of return of 11%. So you see how this works? The less risky the project on the risk index scale, the lower the required return, or the RADR that we'd use in determining the capital budget. So if a project has no risk, then the return only has to really match the risk-free rate. Okay, so project A is riskier than project B. It's expressed as this RADR is 14%, which is greater than 11%. So when we calculate the net present value of these two projects, we could do this in Excel, and this will be part of our Excel project for the chapter. We can calculate the cash flow of project A, and project A has an even stream of cash flows, which we discussed earlier, $14,000. And we take away so the present value of that is $48,000. At the 14% RADR, subtract the initial investment, we get net present value of $6,000. Here are the formulas here of how this is calculated. Project B, we have to calculate each cash flow separately because they're not even stream like project A. So we find the present value of the cash flows from year 1 to 5, subtract the initial investment, find the net present value using the RADR, and we get $9,000. So in this case, the net present value of project B is higher than A. We should choose project B. Okay. And we have a little if statement here to automatically select project B, which you'll see in the homework for this chapter. If we put this on a time scale, we can see here's project A when we discount all the cash flows at 14%. And here, if we discount each cash flow individually at 11%, which we have to do individually because this is sort of a present value of annuity formula, and this is multiple single value formulas because we can't put them all in, because they're different cash amounts. We have to do them each individually. All right. Now, when we talk about portfolio, let's talk about portfolio for a minute and discount rates. Now, an individual investor has to hold a diversified portfolio because they want to minimize risks. They're not rewarded for assuming diversifiable risks. So that's for individual investors. But business firms can be viewed as, business firms can be viewed as a portfolio of assets. And it would seem that it is also important that they should hold diversified portfolios as well. However, that's not really what investors want. Investors are diversifying themselves, so they don't need the firm to diversify for them. So we can, as an investor, we can diversify by buying 5 or 6 different companies, up to 20 different companies, but we're fine with the company being less diversified and being more specialized because diversification isn't necessarily rewarded on a corporate level. Just think of it this way. If McDonald's diversified into running schools and into making cars and into making cell phones and into a number of different types of businesses and diversify their sources of income, that's not highly rewarded. In fact, even at one point, McDonald's was trying to diversify into different food restaurants. They bought Boston Market. They had investments in Chipotle. They had investments in the pizza chain, and they eventually sold those investments to concentrate on the McDonald's brand. So we don't want these companies they're not rewarded for diversifying because investors can diversify themselves. So therefore, companies should focus on what they do well, not try to diversify their risk, but concentrate on the area where they can make the most money. And that's why in a capital budgeting, you're not really trying to diversify your company's businesses because it's proven through empirical evidence that that's really not what investors want, and it's not what it's not what makes companies successful. Okay, so we could have risk classes. So it's another thing we could do to help determine the RADRs is to decide on different risk classes to analyze projects. So we can have risk classes, say from risk class 1 through 4. So 1 being below average risk and 4 being the highest risk. And then we could make an adjusted discount rate based on these risk categories. So it's just another way of trying to formalize the process of how we're going to adjust the discount rates based on risk. So we could use this risk classification schedule as an example. So if a financial manager has, project A was in class 3 and project B was in risk class 2, then we would be using an RDR of 14 for an A and an RDA of 10 for B. So project A at 14 was calculated in the previous figure as 6,000, and the net present value for project B at 10% would be, let's see, this was actually 11% previously, but so at 10%, it's actually higher at 10,000. So again, even using this risk classifications, project B preferred over project A. Now, what if projects have unequal lives? Not all capital budgeting projects are going to be a standard 10 or 5 years. They may have unequal lives or lengths of projects. How do we compare projects that have different lengths? Well, here's an example of 2 projects, X and Y. One is only for 3 years, and project Y is for 6 years. How can we make them comparable? Well, we can, we'll see, the cost of capital here is 10%. So if we actually did the net present value of both projects separately, we get 11,000 and 19,000 would be the net present value for both projects. Now, but that's not really comparable because this is 19,000 over 6 years and this is 11,000 over 3 years. So which is better? So if we ignore the lives of the projects, that makes it easy. If we don't really care about the length of the project, then we would choose project Y over X because it has a higher net present value. However, if we want to use an annualized net present value approach, which was going to help us to evaluate the unequal lives of two projects, we can do it in 3 steps. So step 1, calculate the net present value of each project over its life using the appropriate cost of capital. 2, convert the net present value into an annuity having an end life, and that is find the annuity that has the same life and the same net present value as the project, and select the project based on the higher one. So let's just go through these 2 projects. And it's confusing the way I said that. So let's kind of go through the example. So the company data presented earlier from X and Y, which remember, let's go back here. This is X and Y, and we had the net present value at 11 and 19. So that's where I get these numbers from. X, net present value X, net present value 1. So step 1 we've done many times, calculate net present value based on the inputs for X and Y. Now step 2, what we're going to do in step 2 is we're going to convert the net present values from step 1 into annuities. So for project X, we're trying to find the answer to the question of what 3-year annuity, which is equal to life for project X, has the present value of 11 million or 11,000. The net present value of the project X. Likewise, we do the same for project Y in step 2. So if we use this formula here, the ANPV, which basically we'll see how we do this is we use the payment function in Excel to calculate the payment of the annuity for project X and project Y, and we see that project X has a higher annual payment than project Y, and that would lead us to now choose project X over project Y, annualizing the present value. And again, it's very simple to do this. We would use the payment function to calculate the cash flow of the annuity in the Excel spreadsheet. Again, we'll be doing this in the end of chapter problem work. Okay, so step 3, reviewing the ANPVs, we see that project X would be preferred now over project Y because project X has a better, a higher annualized net present value than project Y. And assuming these are mutually exclusive, we can only pick one. We would be picking project X over Y. Okay. So let's talk about real options. Now, trying to bring some real. This chapter is really about trying to bring some more real-world issues and risks into the capital budgeting process. Because chapter 10 and 11, the capital budgeting process was a little more sterile. In this chapter 12, we're trying to talk about risk in more real-world scenarios. The projects have different risks, projects have different time frames, and we have to make adjustments for that. Now, real options look at opportunities that could be embedded inside of projects that we should also consider or also utilize to adjust the risk. So recognizing the options when making a capital budgeting decisions, managers can better improve their future returns or their strategic decisions, considering in advance the economic impact of certain actions taken by the project. So we have the traditional net present value that we know how to calculate, and we can add to that the value of a real option, and that would give us what we call a strategic net present value. So let's talk about what are the real options. What are so think about companies. Think different opportunities companies have when they take on certain projects. So certain projects are the foot in the door projects. So if I take on this project, say with the school district, this small project of doing this one type of service, then they get to know me as a vendor, they get my foot in the door, and then I should be able to more easily sell or work with them on bigger projects. Say, if you're a local landscaper, you may give a discount on the fall cleanup, a very attractive fall cleanup price, in hopes that you'll gain a more lucrative summer contract of weekly landscaping. So some of the major types of real options that the chapter talks about here is abandonment option. So the option to abandon or terminate the project prior to the end of its life, meaning that you can end the project early. So if there's a problem with the project, you can minimize the damage and get out of it more easily. So if you're taking on a project where you have some guarantees or some reassurances that you could end the project without being financially hurt early, that is something that should be considered when making the capital budget decision. Flexible options. If you have the flexibility within the capital budgeting decision to do other things to maybe generate some additional income. So maybe it's some sort of flexible factory that if you're able to reconfigure the factory to make other projects. So maybe you're a car manufacturer and you're building a new manufacturing plant to make cars. Most manufacturing plants to make cars are not flexible. They're made to make one type of car, either a sedan, a truck, a particular economy class car. But if you were to invest a little bit more money in the factory, you can make it a flexible factory. So if you looked at an inflexible versus a flexible factory, the inflexible factory would have higher net present values because a flexible factory would be more expensive initial investment to make. But the flexible factory can allow you to switch over from sedans to trucks or trucks to luxury or luxury to economy class vehicles very easily. There is additional value in that should be added to the cash flows when deciding whether or not to make this decision, because you're recognizing that there's an embedded advantage to taking the flexible factory. Growth options. So if a particular project helps you to expand the market, for example, we're going to invest in a store location, maybe we're a Walmart and we want to invest in a store location in Spain. This is sort of we know that this initial location will lose money because we have to advertise for one store, we have to build a network and an infrastructure for one store. So this first store is going to lose money. So the net present value of opening up another store in the United States versus a new store in Spain would be, net present value would say open up this new store in the United States. But the growth options is if this one store works in Spain, we can open up 100 other stores in Spain more easily and be more able to expand growth in the area. So if there's an added benefit of additional future growth, that should be recognized as a real option. And then also timing option. So this option recognizes the firm's opportunity to delay the acceptance of a project for one or more periods. So to accelerate the process or slow down the process based on new information, or shut down the project temporarily without extreme costs. So timing options, having the ability to time your investment, is also another real option. So these real options are just things to think of beyond the numbers of the capital budgeting, beyond the risks that we can put into it. We're thinking beyond the project and the bigger picture. So real options connect the company more to the bigger picture of why we're doing this. So all right, so how do we recognize these real options in our project? So assuming that a strategic analysis of, again, this Bennett company, Project A and Project B, we find no real options embedded in Project A, but two real options embedded in Project B. So Project B, during the first 2 years, we would have downtime that we could use the production facility to do contract manufacturing, meaning that we could use some of the facility to actually make products for somebody else and they'll pay us for it. And B, the computerized control system that controls the two machines for Project B, we're able to utilize a control system for other machines, reducing our labor costs. So Project B has these sort of special benefits in it compared to Project A. So how we could do this is we have to estimate the net present value of the contract manufacturing over the next 2 years following the implementation of Project B. So we know that it'll be $1,500 and the net present value of the computer control system would be $2,000. So $1,500 is the value of the contract packaging, $2,000 of the computer control system. So the management feels that there's a 60% chance that the contract manufacturing option would be exercised and a 30% chance the computer control system option will be exercised. So the combined value of these two real options we could lay out in this mathematical formula. So we could say 60% times 1,500 plus 30% of 2,000 would give us a real option of 1,500. Okay. All right. So now if we add the $1,500 of real option to the value of the traditional net present value, we're going to elevate that to 12,424 for project B. So now if we look at it, project B has a strategic net present value of 12,400, which is well above its traditional net present value and exceeds project A's net present value of 11,000. So now project B is more acceptable than project A. So recognizing and quantifying project's real options helps to improve our decision-making abilities within capital budgeting. Okay, now capital rationing. This is an understanding that companies have limited amounts of funds. So they have to ration their capital based on the independent projects available and the capital they have available to invest in those projects. So most companies have more projects than the money and the ability to invest in them. So in theory, capital rationing should not exist because firms should be able to accept all the projects that have positive net present values. However, in practice, firms are under a capital rationing, meaning there's a limited amount of money and also manpower to take on all these projects. So generally, a firm tries to isolate and select the best projects to invest their money in, to utilize their, to raise funds and utilize their capital budget as best as possible. So we can do the internal rate of return approach, where we ration our projects by graphing the internal rate of return in descending order against the total dollar amount invested to determine a group of acceptable projects. Now, the graph, which we're going to show in a minute, that plots the projects on the internal rate of return in descending order against the dollars invested is called the Investment Opportunity Schedule, the IOS. So the problem is that this technique does not guarantee the maximum dollar return for the firm, although it's easily understood. This is the chart right here. It's easily comprehended. So here's project B, C, and E, and our budget constraint is we can't go over 250,000. So we'd have to stop at accepting just these three projects, and project A, F, and D, we'd have to let go because we don't have enough money for them. So if we look at these, the cost, assuming cost of capital of 10%, the 6 projects we're competing for have, if we have 1, 2, 3, 4, 5, 6 projects, here's the internal rate of return. We see all of them but one project is above 10%. So we could theoretically, if we had enough money, we could accept 5 of these 6 projects. But we have a fixed budget of 250,000, so it's sort of a puzzle. Which is the best selection of projects to maximize the company's profits? So we talked about the IOS schedule, but generally it's not the best methodology for improving the company's wealth. Now if we look at this schedule and project B, C, and E, if we accept B, C, and E, based on that IOS scale, together they'll absorb $230,000 of the budget. Project A, Project A and F are acceptable, but cannot be chosen because of the budgeting constraint. Project D is not worthy because it's only 8% return, and we need 10 or better. So the net present value approach of capital rationing is based on using the present values to determine the best group of projects to maximize the shareholders' wealth. So implementing the ranking projects a basis of internal rate of return, then evaluating the net present value benefits for each of the potential projects, we determine the best combination of projects with the overall highest present value. So here, if we look at these projects, we see that here's the initial investment, the internal rate of return, and then we also have the present value of the cash flows. So all these 5 are acceptable, only project D is not acceptable. So if we look at projects B, C, and E together, they yield a present value of $336,000. However, projects B, C, and A, if they were implemented, the budget would be up to $250,000. So we could do B, C, and A. So this would be B, C, and A. So 70 plus 100 is 170,000, plus 80 gives us our $250,000 that they're talking about here. So the present value of those cash flows would be greater at 357,000. So implementing B, C, and A would be preferable because it maximizes the present value of the cash flows for the given budget. Now the firm's objective is to use the budget to generate the highest present values inflows of cash possible. That's really the objective. Now, so when we're doing this capital rationing, we wouldn't, the internal rate of return iOS schedule would not have us choose B, C, and A. But if we look at it this way, we can figure out that, you know what, B, C, and A is a better grouping of projects to get the return that we need. Okay, so those are some of the main, I've covered all the main learning goals of Chapter 12 and discussed capital rationing, scenario analysis, simulations of Monte Carlo, adjusted discount rates for risk and for time, and this gives us, and also real options. So this gives a better, more real-world perspective on capital budgeting and some of the more nuanced factors influencing a manager's decision of how to put a capital budget together to optimize their present value of their cash flows based on the projects that they can accept. Okay, thank you very much for listening to this entire lecture. Please click the like button if you like this lecture, and I'll talk to you next time. Thank you.